Hello and welcome to today's premium account market update for March 2019. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offered presented in this material and realise that not all investments are appropriate for every individual. Moving straight into a graph of the XJO, up on screen there, you can see that we've had the heavy sell-off in the December quarter. The market's rebounded and now creating this lower high formation. If we look at the algorithm model, it switched from sell conditions to buy conditions back in 2016. And we're now under sell conditions. So during that period, the market put on roughly 20% and delivered a 4% annualized dividend yield. So total returns roughly 28% over that period. The caution that we now face is this lower high pattern is consistent when we look back through history of any kind of technical setup prior to a fairly significant market sell-off. So some caution needs to be exercised. And what we're going to do now is roll through the ASX 50 stocks and just have a look at the technical patterns that are driving sort of the market from where we are at the moment. So we click on watch list, we go to ASX 50, load them up, we'll put them into alphabetical order. You could either sort them by algorithm sell or buy signals as well, or percentage gain or loss, but in this case we'll do alphabetical. Let's start with AGL. AGL's earnings disappointed. I think the tailwind that's helped to drive this recovery here really was the beginning of interest rates falling in the US. I think for the most part that adjustment's played out in the market. At best, AGL now moves sideways. It's on an attractive yield, sort of 4.5% yield. So we don't see too much downside in most of these utilities, real estate investment trusts, infrastructure names, etc. So in the case of AGL, whilst it's under sell conditions, we think it sort of stays now under that 22 resistance level, but there's probably not a huge amount of downside there. Aristocrat, this is an example of a high PE name. Some of its growth drivers are maybe under question. So it's a favourite among fund managers. They really like this stock. It's a core holding. They see it as value at a reasonable price. But for us, we recognise it's now under algo sell conditions and we're a little bit cautious on it. Amcor, this has been one of our high conviction ideas. So this stock has rallied as a result of the company providing clarity around a return to earnings growth. Now, to put that in context, it's still very low single digits. They're only going to grow earnings maybe somewhere around 2 to 4%, and that's providing the global economic backdrop stays fairly robust. What the positive is here is the merger with the Bemis Group, which is the New York Stock Exchange listed competitor that they acquire in the second quarter of this year. There's $180 million of cost synergies to come out of that merger over the next 2 to 3 years. So that underwrites some potential weakness in general global economy that may impact Amcor. So we'd be a buyer of Amcor on a retracement back to $14, but for the most part we see it full value where it is at the moment there. AMP not doing anything there at present. ANZ's the only bank of the major fours and the two regionals that's been in our model portfolio. So we're buyers of it down here to around 24.50, and we've actually just started taking profit on ANZ at the moment, even though that it's not under sell conditions. And the reason why I say it's not under sell is the most recent signal was actually a buy. We've actually locked in profit just because of the concerns around the backdrop of the broader market. APA Group, so this is the gas pipeline business. You may recall late last year, Hong Kong Group made a takeover bid for APA. That's what drove this jump in price through here. The sell-off came when the government blocked the takeover proposal, and then this last part of the rally has been helped by lower interest rates and money flowing into yield sensitive names. We think it's back near full value, but a little like AGL, we don't see that as an area of the market that's likely to come under significant selling pressure. ASX delivered about 6% underlying earnings growth, slightly ahead of what the market was expecting. And this has been a real sort of market favourite where rather than allocating money to the banks within the financial services sector, I think ASX has received a disproportionate allocation by fund managers because of them generally not wanting to own the banks. It is expensive, but high quality business. I suspect that we're in an environment where the ASX mostly consolidates now and trades sideways, but I'd expect it to stay up near the top end of that resistance. So if we look at the algorithm model there, it shifted from sell conditions to buy conditions at $46 and had further confirmation buy conditions there at that low at 57. Horizon. So we've traded out of this one. We had the buy signal there at around $4.20. We had the sell signal, so we're recognizing that the stock's rolling over. Keep an eye on this one over the coming months. My view is that maybe it comes back down, tests sort of this 420 area in a weak market, and that provides probably a reasonable long-term entry level into Horizon. BHP, cautious now on these resources. We think the rally's a bit extended and subject to a pullback, and we're happy to take a look at BHP mid-year on a higher low or an algorithm buy signal, but for the time being we think they're a bit extended. Brambles. So the issue here, again, underlying earnings growth was actually only running at 2%. The stock trades on about 22 times earnings, so it's very expensive. They have finalised the detail around the sale of their plastic pallet pooling business, which is going, I think, to maybe a joint venture entity with the Abu Dhabi Sovereign Wealth Fund. I think from memory. But that capital will be partly returned to shareholders through a 29-cent special dividend. There may be some, I think there was $300 million of share buyback, and then the rest will go to retiring debt. But the stock is very expensive, so for us, you're better off taking profit and just waiting for an opportunity to accumulate it at lower levels. CBA under sell conditions, so we just highlight here that we've had sell conditions at 76, and then again at sort of 73, 74, so cautious still on the banks. Cochlear, we had sell conditions here at so roughly 200. The stock's now moving 170. It looks to me that it'll come back down and test that 150 level. Coles, not enough data here really to form a view on the technical side of it. We look at the fundamental data. The latest earnings results out last week showed that the earnings fell below analyst estimates. The stock's on just under a 5% dividend yield, but I think Coles and Woolworths will be an okay place to hide out if market volatility picks up, but they are very low growth businesses at present and trading at relatively high valuations. So for me, owning them and selling covered calls is the right strategy. Computershare, I've been bearish on this. I've been talking for a while about the likelihood of it rolling over. I think from a PE standpoint, it's expensive, and I just sort of question, the true underlying growth of the business. I think so. There's a lot of cost cutting and helping to sort of the strong US dollar. There was a few tailwinds there combined with the company doing cost cutting that sort of made the picture look better than what it, I think, structurally is. So we've now had a breakdown, make a lower low. We're under algorithm sell signals there at roughly sort of $19, and we're seeing the stock move lower. Going out 12 months from here, to me, fair value for Computershare is probably back at $13, $14. So we'll wait and see how that plays out. CSL, I like this. The growth is slowing a little, back down to around 10% underlying EPS growth. So it's slightly on the expensive side, but I'll be inclined to be a buyer of CSL between sort of, say, this 160 and 180 level. I wouldn't see it going too much below that. Caltex announced a share buyback. I think it's an off-market buyback. The capital component of the sale price will be a low level. The rest will be handed back in a franked dividend, so that's attractive for low tax threshold investors. From a valuation standpoint, around $28, $29 seems fair value based on where earnings are and dividend yields at the moment. DEXA, so these property trusts is really something that's just worth pausing to have a look at what's gone on here. So as US interest rates fell in the latter part of last year, we've seen a huge acceleration in yield-sensitive names. My view is that interest rates stay low, so these names continue to get some support. But from a valuation standpoint, they're certainly starting to look expensive. But we can see here it's switched from sell conditions into buy conditions. They're at around 970, and it's put on about $3 since then. Fortescue, big breakout in iron ore prices. My view, whether it's Fortescue, BHP, or Rio, to me, their rallies all look a little extended in those at the moment. Goodman Group, so another example, property trust switched from sell conditions into buy conditions at $10, now $12.88, so it's put on about almost 13, sorry, it was put on almost about 30%, 28% since the buy signal there. So keep an eye on Goodman, continue to buy the dip long term in Goodman. Likewise in GPT, we had it switch from sell to buy here at around $4.80, stock now pushing $6. GPT's growing earnings at around 4%. Combine a covered call, you're starting to deliver reasonable returns. They look a bit expensive. Insurance Australia Group, even though we've switched from, so if we look at the history here, we went from buy conditions here at 560 into sell conditions at 770 roughly. So it's been removed from the model portfolio at the moment. Insurance Australia Group probably stays under that 770 resistance, but mainly bumps sideways. But certainly the number of stocks in the model portfolio now have been dramatically reduced as we've seen these lower high formations play out across the market. James Hardie, so this was a negative return stock for the model portfolio. It's created the lower low, creating the lower high. These building stocks got oversold. During our opportunities in review webinar, I spoke about the likely bounce that we're to see in them. I think that's, again, played out, given that we're just in this backdrop where the major global indices are probably pretty close to resistance. So for me, I would see sort of James Hardie between sort of 18 and maybe 1950 starting to run into some resistance. I just highlight that there is some sort of price gap there back up to about 1950 if you have a closer look at your chart there. Lendlease, the cost overruns from this engineering business are substantial. Obviously, it's having a significant impact on the earnings results that's just been announced, but there's still very good long-term value here in Lendlease. If we have a look at the sell condition, that was pretty clear. Sell condition there at $14. The stock's moving lower, so we really should be exercising patience and waiting to see a new higher low formation there in Lendlease before getting too aggressive on the long side. Mirvac under sell conditions, which I think that weakens from where it is at the moment. Medibank private under sell conditions. Medibank delivered very little in the way of earnings growth, which was our expectation. At about 4.5% dividend yield, the stock looks full value, and at $3, it's sort of pushing into the lower end of that yield range. Fair value for me is back down at around $2.50, which would put it back on about that 4.5% dividend yield, which is where it should be trading. Macquarie Bank, 15% earnings growth, reaffirm that. High quality business. And I think this is one that you want to continue to revisit on the algorithm buy signals. Again, bit of caution there because of the pattern or the setup in the global indices at the moment. NAB, we had the last sell signal there at around $28. Stocks trading lower. Newcrest Mining, a little bit cautious on gold at the moment. It's had a very good rally, but our preference has been Evolution, North Star, and Oceana Gold, and we'll revisit Newcrest maybe throughout this year when we see it develop an algorithm buy signal. Origin Energy, fundamentally, we like what's happening here. The company's paying down its debt, reinstating its dividend, but very cautious here about the technical setup there. So that looks like it'll probably keep some downward pressure on Origin. So the key level there would be to see if price can break back up through 770, but it's a bit of an ominous sign, the sell signals there building. Orica, so sell signals here, if we look at the history, it's shifted from buy conditions into sell conditions, and the stock's continuing to make lower lows, lower highs, and around 18.50. We've got resistance there at the moment. Oil Search resistance up at $8.50. Terrific business, Oil Search, good long-term growth, but the signals that we're starting to get through the market suggest that we're going to be running in a resistance, and we might get an opportunity to buy Oil Search at much lower levels. Qantas under sell conditions here at around 630, so avoiding that at the moment and thinking about it on the short side. QBE, so this is one of the few stocks that are in the model, so we saw it switch from sell conditions into buy conditions here at around 950, and the stock's pushing up towards $12. We are seeing a slow turnaround in QBE, and to me, sort of $12 is about fair value at the moment based on what we know off the back of the latest earnings result. Ramsay Health Care, so just to point out that we're seeing a recovery here in Ramsay, but it is under sell conditions. The attraction here is they report earnings results on Thursday, but it's a very defensive area of the market, and you're starting to see money look around to rotate out of some of these higher value momentum plays into sort of defensive value areas of the market, and I think Ramsay's received some rotation of capital in the lead up to the upcoming earnings result. I don't think there'll be anything that really shoots the lights out with the result. So at about 3.2% dividend yield, $60 a share is about fair value for Ramsay. So it's really a yield play from where we are at the moment. Rio runs into resistance. The resource is overextended. South 32 runs into resistance. Centre Group's a little bit of support here. This is Australian Shopping Centres on a 5% dividend yield. The company's doing a share buyback, but at around 380, 390, it's full value. So own it, sell very tight covered calls, strip out 10% cash flow, not too much in the way of capital growth. Stockland under pressure. We can see it switched from buy conditions into sell conditions here. Lower low, lower high. Most recent signal there around 390 for the moment. We see that moving lower. Sonic Healthcare, 3% earnings growth, 3 to 4% earnings growth. I think they just completed a major acquisition in the US. Did a discounted rights issue at $19 a share to help pay for the, I think, 750 odd US million dollar acquisition they did. But the business is pretty stable across Australia, Europe, and the US. So whilst it's under algorithm sell conditions, I don't see too much downside. But at $25, the stock's expensive, low 3.5% dividend yield. So to me, it's justified that it runs into resistance, but I would be happy to be a buyer of it again back down to around $22. So we'll keep an eye on that. Santos, after a terrific run with oil prices over the last 12 weeks, or 8 weeks, Santos runs into resistance, a little like Oil Search, and we're big keen buyers of it on the next pullback. Suncorp under resistance, I think lower low, lower high. Suncorp's 1370 is resistance, and I think given sort of our concerns around the backdrop of the broader market, we think Suncorp probably rolls over or struggles below that sort of 1370, 1350 level that is on the chart there. Sydney Airport's an example of where sort of these yield sensitive names are doing well. Sydney Airport's back up at around $7 to $7.50, looks full value, and you'd want to be selling calls over that. As with Transurban, attractive because of its being a defensive yield. We see risk coming out of the market and switching towards some of these yield sensitive names, but they are expensive, so we don't see too much more upside in them. So I think owning them, selling covered calls is the right approach there. Telstra, so it's under sell conditions at the moment, but it looks like we're starting to form a base which would be consistent with commentary out of the company, which suggests that they can support the current dividend yield over the next year or two, and hopefully we start to see a gradual recovery in earnings. Earnings will probably bottom eventually at about $7.5 billion, which is down from around $11 billion post the NBN payments washing through. So I think for another 12 months, the dividend's supported. It's worth noting the breakup of the current dividend being 5 cents dividend, 3 cents special. It makes you wonder, though, sort of a couple of years down the track, do we get to a point where the total payout's actually only 10 cents, not 16 cents per annum. But even on that basis, it would put Telstra on about a 4% dividend yield instead of a 6.5% yield, which still makes it attractive. So the downside risk to Telstra seems fairly limited, but obviously we're not seeing that higher low formation develop yet. Treasury Wines delivered 20% earnings growth. The market had pretty high expectations on this stock. We've had it switch into sell conditions there at around 17.50. So for us, we're selling tight covered calls over it, but we recognise that there could be the risk that the stock sort of trades down to that $12 level over the course of this year. We may get a chance to buy that on better levels. Vicinity, so property trust under buy conditions. The earnings result was uninspiring. We've seen the share price correct relative to the other real estate investment trusts, but at around $2.40, I think in a low interest rate environment, it starts to find support. Westpac, worth noting the current sell signal here, and I think when we look across sort of CBA, NAB, Westpac, the regionals have already sold off. But if you have a look at them and look at the algorithm signals on them, probably Westpac's one of the ones that's trading close to the original, as with CBA, maybe close to the sell signal. So the Westpac and CBA probably look like the ones that are most likely to roll over under a soft market and provide the most downside. Wesfarmers, $2 of dividends, $1 special dividend that was announced yesterday, or went ex yesterday. So the fall in the stock for a large part's a result of that dividend. To me, Wesfarmers, you're obviously taking on some retail investment exposure with Bunnings and Kmart and Officeworks, etc. So the 5% dividend yield's attractive, but I think owning it, you'd want to be selling a very tight covered call to try to boost that cash flow. I just don't see that in a lot of these cases it's worth the risk for a 5% yield on its own. If you're getting sort of 10% through a derivative overlay, then it starts to add up a little more from a risk reward point of view. Woolworths at 24 times earnings, the stock was just too expensive. I've been speaking to that on prior recordings at $27. I think it's fine to step back into the market and be a buyer of Woolworths with a view of selling covered calls. Woodside Petroleum, it's under buy conditions here at around $30. We've taken profit on it, looking for oil to pull back, and we get an opportunity to buy the next dip. And there we are back at the index. So not to be too much of an alarmist, but I think if you're running a large investment portfolio, I think you need to really be watching the market closely. I think sort of one of the ideas that I'd advocate is that looking at the XJO here, we've had a very strong recovery from the December low. And it is hard. We may see this continue to rise further. So one reference point, and I'm not normally a big sort of promoter of decisions in the market around moving averages. So I guess this is something that I'm just highlighting as a special sort of situation where it's a way of tracking. So if this is a 10-day moving average, it's snugging this uptrend in the market at the moment. If we were to see the XJO start to roll over and close below that 10-day moving average, then to me that would be fairly consistent with the primary signals around our algorithm model, just saying that the buying's starting to exhaust, and the risk is once that a little bit of profit taking starts to develop, you could see a fairly accelerated move to the downside. So for us, we've built up large cash positions in our client portfolios and just made sure that we're out of risk names for the moment. If you'd like to know more or have a chat about the market, please email me, leon@investorsignals.com.